Our next guest says to focus on names that are well-positioned in the current volatile backdrop. David Chiaverini, Wedbush Securities Managing Director, Equity Research, joins us now. David, we'll get to which banks you see as better positioned than others. I know that you cover some of the regionals, but first I want to get your biggest takeaways from what the results we've been seeing so far this morning.
Yeah, I'd say the big takeaway is, interestingly, even though JP Morgan deposits were up 37 billion, the other big banks didn't see as big of inflows as one would expect, because the mid-sized banks we saw from the H8 data saw 200 billion of outflows. So it goes to show that more of this money is going to money market funds as opposed to the money center banks. So it doesn't necessarily bode well for the mid-cap banks that have yet to report.
And I know that you cover some of the regionals, and you have some names that you say that investors should focus on when it comes to this volatile backdrop. So quickly, what are some of the ones that you see and outperform?
Yeah, the ones I like here are New York Community Bank, Regions Financial, Fifth Third Bancorp, and M&T Bank. And the reason for these four is that they have higher levels of insured deposits. And given this volatile backdrop, it seems as if depositors really like the safety of that insurance backing from the FDIC. So these are very well-positioned banks in this environment.
And Citi CFO Mark Mason this morning said that Citi has tightened credit underwriting in consumer loans. Do you see credit tightening when it comes to underwriting in the regionals as well as, could we see what we see in the bigger banks?
Absolutely. We've been seeing it for the past few quarters, looking at the senior loan officer surveys that come out quarterly. The next installment of that is coming out in early May, and we do fully expect continued tightening across the board, especially seeing these deposit outflows by necessity means that balance sheets are shrinking for the banks, and they are likely to tighten standards as a result of that. So we do expect continued underwriting standards to tighten, and credit availability to come down in ensuing quarters.
David, commercial real estate has been also in focus, and I know that the regionals also tend to lend in this space. What are you seeing there? Does this concern you?
Yeah, so right now, credit quality is excellent for commercial real estate loans, so not an issue at the current moment. But looking forward, we are expecting some weakness on the commercial real estate front. Non-performing assets are likely to go up, and while that certainly won't be a good look for the banks, the loan-to-value ratios, and this is very important, the loan-to-value ratios for commercial real estate across our regional bank coverage is around 55%. So that gives tremendous cushion to ward off realizing losses related to these loans. So again, non-performing assets likely to go up over the next 12, 18 months, but we're not expecting losses to actually come through because of these low LTVs.
And I know that on your list, you also cover First Republic, and we'll be hearing from First Republic later in April. I'm curious if you see a sort of bifurcation between the bigger banks and the regionals, that some of the ones that have suffered more than others when it comes to what's been going on in this banking turmoil, this recent banking turmoil.
Yeah, First Republic is a unique issue in that they had a high level of uninsured deposits combined with the fair value marks on their loan portfolio actually would take their tangible equity deep into negative territory. So that's what's made it difficult for the investment community to rally behind First Republic with a recapitalization, and also prevents the company from doing a voluntary sale of the company. So I am expecting deposits to be under pressure for First Republic. Now, I would say the silver lining for First Republic is that the Fed, the Treasury, they're providing tremendous liquidity to banks like First Republic. So First Republic can pledge loans and securities at par to the Fed, and they can pretty much handle any deposit redemption requests that are coming through because of that increased liquidity. So even though the backdrop isn't great for First Republic, we're not expecting receivership to come through anytime soon because they are able to meet these deposit redemption requests given all of the liquidity.
And David, are you watching anything in the M&A space? Are there any top takeover plays that you see on the horizon?
Yeah, there are a number of banks that I would say that are trading, at the low end of price to tangible book value multiples. And those ones that are probably, seeing more stress are more likely to see a potential takeout in this type of environment. We're not going to see many many big banks on the prowl from an M&A standpoint, but in a distressed situation, I could absolutely see some banks being sold, similar to what we saw with SVB and their bargain purchase. When they were sold in an FDIC-assisted deal. Signature Bank, same situation when they sold certain assets and deposits to New York Community Bank through an FDIC-assisted deal. So those distressed sales I can absolutely see occurring, especially for some banks that might be in a liquidity bind and potentially be searching for some capital here.
David Chiaverini, Wedbush Securities Managing Director, Equity Research. Thanks so much for joining us.